Welcome to Buy, Hold, Sell, brought to you by Livewire Markets. My name's Jessica Amir from Bell Direct. Today we're diving into 6 dividend stocks. In fact, 6 stocks that pay above market dividends. I'm joined by Neil Margolis from Merlon Capital and Michael O'Neill from Investors Mutual. Let's start with you, Michael. Fortescue Metals, buy, hold or sell?
Fortescue's a sell. Much better company than it was 5 years ago in terms of balance sheet, cost of production. But iron ore prices are at $120 per tonne, having been held up by supply disruptions and also stimulus in China. And we see the share price as very much exposed to a correction of that supply and demand imbalance.
Neil, Fortescue Metals, buy, hold or sell?
I agree, Fortescue's a sell. We think about everything as a range rather than trying to pinpoint one number. If iron ore was to stay at these record levels, maybe there's 20 or 30% upside. But we think there's up to 80% downside if it corrects back to long-term levels. So for us, that risk-reward is tilted to the downside. So notwithstanding the high short-term dividend, it's not sustainable and we don't own it.
Okay. Staying on you, Neil, Telstra, their shares are not doing so well of late. Buy, hold or sell?
Telstra's a sell still. We wrote an article last September about this on our website. The company, the cash flow of the company is not that strong. By their own measure, the underlying earnings are around 10 cents a share when you exclude the NBN disconnection payments. That still includes a little bit of a contribution from the fixed line business, which we ultimately think is going to be a break-even proposition. That's reselling the government NBN. It's going to be hard to make money on that. So you're left with a mobile business, which is a good business, but the margins and prices are high. So we think that underlying earnings of, say, 10 cents, maybe a dividend of 7 cents. The market is still pricing it as if the dividend is 10 to 16 cents. So we think it's a sell.
Thanks, Neil. Michael, what do you think? Telstra, pretty tightly held, buy, hold or sell?
Telstra is a buy for us. It's on a 5.5% yield. It does have 50% market share in fixed line and mobile, and fair to say they've been through a very tough period of competition from Optus and Vodafone at unsustainably low returns, and something's got to give. And we see their 5G leadership as underpinning some return to improvement in market share and also margin over time.
All right, let's stay on you. Medibank Private, speaking about something else to give, buy, hold or sell?
Medibank is a hold for us. Now, Medibank has no debt, so if you're going to own a health insurer, it's the one to own. Certainly preferable to owning the hospital operators themselves, but they've seen 5 years of improvement in margins and coverage has fallen. We're heading into a recession. Policyholder participation is going to fall, and so we see it as very much exposed to those dynamics. They've already committed to giving back the savings from elective surgery from COVID.
Thanks, Michael. Neil, Medibank Private, buy, hold or sell?
I think it's a buy, but we prefer NIB Holdings or NHF, which is even cheaper than Medibank and broadly similar thematics. They have net cash, they don't have debt, which is a positive. They're sandbagging, they're hiding the results because they don't want to be seen to be gouging consumers. There's definitely the key concern is about affordability and membership, and that is an issue. NHF also has the travel insurance business, which is loss-making, but will obviously recover, and we are long-term investors. Ultimately, I think though that private health insurance will be around to stay. There might be some reforms. Maybe younger people pay less, maybe older people pay more. We think net that'll probably benefit NHF, and they'll continue to gain market share. And it's very cheap on a cash yield basis.
All right, Neil, staying on the theme, very cheap, AMP, buy, hold or sell?
AMP is a buy. My beard wasn't grey before we invested in it, so that tells you a little bit about it. But I do think it's very cheap. It's extremely unpopular. Following the sale of the life company, they've got similar net tangible assets now, which is really cash backing it as they had when they had the life company. And they don't need much capital now. So we think about 80% of the share price is backed by cash, and they don't need much. Now the board is holding on to the cash. Fortunately, there have been some positive changes there. We see the new chair as being more shareholder friendly and more willing to entertain a return of much more capital than they've alluded to. One of the key concerns, once they've returned the capital, one of the key concerns is the advice and platform business. But we've just seen transactions there with MLC and CFS that would price that at several $1 billion for AMP. And they have a funds management business that's quite differentiated as well. So we think there's tremendous upside, a company that's been badly run, but there's some signs of improvement and renewal at the board, which I think would be a welcome change for long-suffering investors.
Lots of changes at AMP. Michael, what do you think? AMP, buy, hold or sell?
AMP's a hold for us. I've probably never spent more time on a company that we don't own, and certainly it's starting to look interesting. We agree with Neil. Some of their businesses outside of wealth are doing quite well and could be valuable in a breakup scenario. The concern we have is the sum of the parts is not always greater than the whole. There are execution risks. And as we saw with the AMP Life transaction, a breakup or separation can involve costs and dis-synergies.
All right, Michael, let's stay on you. What stock are you really backing at the moment as paying a high sustainable dividend?
That would be Aurizon. So Aurizon pays a yield of over 6%, fully franked, and they're on about a 16 times PE. They're the largest freight operator in Australia. About 60% of their earnings are regulated from the Central Queensland Coal Network, and the other 40% are on 10-year long contracts with some of Australia's most profitable, largest, lowest cost coal producers.
All right, sounds good, Michael. Neil, what about you? Big dividend payer, sustainable div, what have you got?
Okay, we've probably got something a bit controversial, which is IOOF. I mean, they've recently bitten off a big apple in buying NAB's MLC business shortly after buying ANZ's platform business. The company paid 45-cent dividend last year. Now they've doubled the share count on these two big bank acquisitions. Those are difficult businesses, but the banks are panicking and selling it. So I think it's good to be buying from the banks when they're rushing for the exit. Ultimately, if they can get the earnings of NAB, they can reduce costs in the MLC business. They can get their dividend back to 45 cents or 60 cents franked, and the stock's only on $3. So it'll take a couple of years, but I mean, you do have to, I mean, part of our process is having a long-term time horizon and investing when expectations are very low, and they're pretty low there at the moment.
Definitely low indeed. So plenty of rosy dividends among the thorns.